Now the part of our show where I talk about 3 things that I think are important for individual investors to be focused on before you make your investment decisions. Is trade volatility back? President Trump has ratcheted up the tariffs once again. And just before we came on air, I believe the president sent out another bunch of letters to different countries telling them what the cost will be for that country to do business with the United States. And we've already seen a number of letters go out, places like Japan, places like South Korea, and a number of smaller countries, South Africa and others. And he basically, he meaning the President Trump, set the tariff rate. And that has definitely spurred on a lot of conversation. And the new deadline for a lot of this, well, for the trade deadline now is pushed back to beginning of August 1st from first week of July. So we'll talk a bit more about that. Economic data. We have a Canadian jobs number coming out this Friday. Very crucial for what the Bank of Canada may do going forward. Are we seeing jobs fall? Are we seeing inflation rising? We are starting to see a little bit of a rise in inflation numbers, but you mix that with jobs falling, that would be obviously a difficulty for the Bank of Canada. Cutting interest rates perhaps will stimulate and bring jobs, but it won't be good for inflation. Corporate earnings season, something that I think everyone needs to keep an eye on over the next couple of weeks. We will hear from businesses and how they did over the second quarter of 2025. Who starts off every corporate earnings season? The U.S. banks, U.S. big banks. We'll touch on those and what to look for, as well as talk a bit about one big tech company that's extremely important, especially to AI. So let's get into our first topic that I think individual investors need to focus on, which is trade volatility. Is trade volatility back? And interesting that the U.S. is trying to push the envelope. They're trying to get trade deals done as soon as possible. And once again, the president, whether you think he's bluffing, whether you think he's going to go through with this, but he's talking about bringing back tariff rates if a country does not come to the table in good faith and work out a trade deal in good faith. He's talking about bringing back some of these tariffs to maybe almost back to where they were on April the 2nd when the reciprocal tariffs were announced, perhaps just a little bit lower, but nonetheless much higher than where they are or where they were prior to the president taking office. We're also, hearing about countries and trade deals and Japan, South Korea. At first, they were very close to making a deal with the United States, but we're hearing that these sectoral tariffs, so these tariffs on specific sectors of the economy, has thrown a monkey wrench into the whole negotiation. Tariffs on automobiles is a big one for Japan, South Korea. Tariffs on steel, another big one as well. So these are things that countries like Japan, countries like South Korea, they're having a difficult time, crossing that finish line to get a deal done. Our first, almost like a quote, I guess, is from the Yale Budget Lab, and it's the takeaways on state of U.S. tariffs. And it's a very interesting, take. The Budget Lab estimated the effects of all U.S. tariffs and foreign retaliation implement in 2025 through July 7th, including the effects of U.S.-Vietnam trade framework and the July 7th announcements on new rates for 14 countries. As I said, presidents sending out letters. The Budget Lab analyzed the July 7 tariff rates as if they stayed in effect in perpetuity, so that they weren't going to be changed. And what the Budget Lab found out, which, as I said, is from Yale, that the current tariff rate, consumers face an overall average effective rate in the U.S. of 17.6%, the highest since 1934. After consumption shifts, the average tariff rate might lower to as much as 16.5%, which would be the highest since 1936. So even though tariff rates have come down at least a little bit, and for some countries quite a bit, like China, tariff rates are the highest that we've seen in the last, 80, 90 years. The long-run sectoral GDP and employment effects. In the long run, tariffs present a trade-off. U.S. manufacturing output expands by 2%, but these gains are more than crowded out by other sectors. Construction output contracts by 3.5%, so it drops by 3.5%. and agriculture declines by almost 1%. So talking about, these tariffs and what's happening, yeah, some things can get a bit of a boost, but they get more than offset by the declines in other areas. So, for example, aluminum, when the 50% aluminum tariff was announced, we've seen some aluminum producers, their stock rise tremendously. But then you saw on the flip side, those that use aluminum, cars, automobile companies, companies like Coca-Cola, beverage companies that use aluminum cans. We saw prices actually of their stock drop a little bit because their costs would rise. So you always have to look at the benefits and the negatives. Our next chart here is one on reciprocal tariffs. This is tariff rates by the announcement date. So you can see here on July 7th, the rates on all those countries versus what it was on April 2nd. And the two I'll highlight, one would be Japan. They're talking about a 25% tariff now as of August 1st, unless Japan and the US can make a deal. The reciprocal rate announced on April 2nd was actually lower, 24%. South Korea, 25% as well, and it was 25% on April 2nd. So it's going to be difficult for a number of countries to move forward if you're seeing tariffs of 25%, Myanmar 40%, South Africa 30%, and if you couple those with tariffs on things such as aluminum and steel, and now they're talking about 50% on copper. Trade deals need to get done, in my opinion, not only for these countries, but also for the United States. Think about how much and how high the costs are going to go up on many things in the United States. And I'm not so sure that Americans will be waiting for this or anticipating this. And I don't think it's what they bargained for when they elected the current president. Our next, I guess, a bit of a chart here. It kind of outlines how tariffs have gone, kind of a time frame. And you can see here that towards the end there, modified April 2nd announcement, 10% minimum tariffs on all countries, China, Mexico. You see the China tariffs coming off, the 125, the 145. So again, it's more of a, I guess, a time, more of a calendar of events. U.S. Vietnam, July 2nd framework, 25% broad tariff, 40% on tariffs from goods that China sends to the United States through Vietnam. So the U.S. obviously is not dumb to know to think that China will not try to use places like Vietnam to perhaps bring things to the United States, because countries like Vietnam have a lower tariff rate than they do. So on anything like that, you're going to see a 40% tariff on if the United States finds out that these were Chinese goods that were shipped to the U.S. through Vietnam. So volatility back with respect to trade, with respect to tariffs, and I think the volatility will stay at least for the foreseeable future until we get some more clarity. Second point I want individual investors to focus on is the economic data. As I said, we're going to get jobs data out of Canada on Friday, important for what the Bank of Canada does. And we're going to get CPI and PPI, CPI out of both Canada and the US, so inflation data out of both Canada and the US, and PPI out of the US. Very important for what is happening, right? A lot of people believe that inflation will be moving higher. Our first chart here, Canada's unemployment rate rises to 7%. You can see it there, highest it's been, I guess, in a little while. I guess you'd have to go back to 2016, 17. It's the last time we saw unemployment rate that high. I disregard the big spike during COVID. Obviously, that was not, I would call it artificial almost. Nobody was working at that time, so that's why unemployment was that high. But overall, you could see that in Canada, unemployment rate has definitely moved up. So we'll see what Friday's number brings. Our next chart, CPI in Canada. We have core CPI. We have headline number, 1.7%, still fantastic, below the target. But it's that core CPI, when you strip out volatile food and energy. That number is starting to move back up and getting closer to 3% again, as you can see with the red line there. U.S. Consumer Price Index, our next chart. We've seen this chart many times, 2.4% on the headline and 2.8 on the less volatile food and energy number. And again, we're starting to see inflation numbers start ever so slowly trickle higher. And one of the things I wanted to mention at this juncture in our show is this idea that people have been coming out with, the Trump administration, Secretary Bessent, talking about how tariffs do not increase inflation, that it's a one-time effect on prices. So you might see a spike in prices, but then things slow down and inflation rate comes right back down, and it's really not inflationary over the long term. Well, I have a problem with that way of thinking. They are correct in that inflation measures the rate of change. So if you have inflation that's 2% this year and it's 2% next year, well, that doesn't mean that inflation hasn't, or prices haven't gone up. It means that the rate of change hasn't increased. So it's 2% next year on top of the 2% this year, on top of the 3 or 4% from last year. So prices keep rising. So what inflation measures is the rate of change. So when you have a one-time shock to the system due to tariffs, you see a spike in prices, so that rate of change may go up to 4 or 5%. But then after that, it doesn't keep going up by 4 or 5% because those prices are now entrenched in the economy and they stay the same. So government will say, you see, inflation came back down. It's not moving as high anymore. But the average person out there going to buy groceries, going on a trip, looking to buy a car, whatever, big ticket items for your home, those prices will remain elevated and continue to increase from an elevated level. Very rarely, I don't remember actually ever, we see prices decrease. They only go higher. So if we get a big jump in inflation and spike in prices, and then it comes down to 2%, well, that's 2% on the 5%, let's say, that it spiked higher. And just people just can't handle that. People are already strapped. Prices are already high in the US, Canada. So tariffs will just add to that. So yeah, you can make the argument that tariffs aren't inflationary over time, but I'll make the argument that it all adds up and prices do go higher. Our third point that I wanted to touch on for individual investors to consider is the upcoming earnings season. Of course, that will start up. It looks like Bank of America, JP Morgan Chase, I think they're all reporting on the 14th, Citigroup, Wells Fargo, a whole mix of banks, and TSMC, Taiwan Semiconductor, will also report. I believe they're coming out on the 17th, and they are a very important company to tell us how artificial intelligence chip making is going. And I have a few charts to show. First one is Goldman Sachs. I think earnings from Goldman Sachs will be fantastic. We're hearing more and more about the IPO market. We're going to show a chart on that in 1 second, but you can see here how well Goldman Sachs at all-time highs. Once again, the chart looks fantastic. Let's show the IPO chart that we have. You can clearly see that IPOs have increased significantly. There it is. IPOs have increased significantly, especially tech IPOs. Tech IPOs are outperforming everything else pretty much, 108% versus non-tech IPOs. But the main point for our conversation is that trading has come back, and that is definitely going to help banks and investment companies like Goldman Sachs and Morgan Stanley. Not to mention Morgan Stanley has a huge wealth management business. JP Morgan, our next chart, the largest bank in North America. It's had a fantastic run because of the idea that the United States is reducing regulation on businesses, being able to help businesses grow. And what do they do when they need to grow? They borrow money. And where do they go? They go to places like JP Morgan. They go to places like Wells Fargo, Citibank. And these are the places they go. And that helps companies like JP Morgan and their profits move higher. Interesting to see what they say with respect to net interest margin, which is the difference between what they lend money at and what they pay out on their fixed income products, their GICs or certificates of deposit, as we say in the US, and how much they set aside for bad debts that they anticipate that people will have. Our last chart, Taiwan Semiconductor. Also a tremendous run, almost looks like JP Morgan chart, actually. And keep in mind, Taiwan Semi, they're the ones who manufacture the chips. It's the NVIDIAs and the AMDs and the Apples and a lot of the hyperscalers now, Microsoft, Amazon, they create and design the chips. But Taiwan Semi is the biggest manufacturer of the chips. Now they have some huge plants in the Arizona area in the United States, and they've definitely brought a lot of business to the U.S. Over the last, I guess, last year or so. So corporate earnings season. Keep an eye on corporate earnings. Have an eye on that. An eye on all the trade negotiations, all these letters that are coming out, and the economic data. We always like to talk about the economic data because this, or those three things, I should say, will be very important as to what type of investment decisions you make with your portfolio over the next couple of weeks.